If you've ever wanted to invest in an entire market with just a single click, chances are you've run into something called an exchange-traded product, or ETP. They have become unbelievably popular, and today we're going to dig in and find out exactly what they are and how they really work.
So, have you ever wished you could get in on a whole market, say the entire tech sector, but trade it as easily as a single stock? If that sounds good to you, then ETPs are something you're definitely going to want to understand.
All right, first things first, let's really break down what ETPs are. What are you actually buying here? At its heart, an ETP is basically a security that tracks a whole bunch of other assets. Just imagine a basket, and inside that basket, you could have stocks, bonds, maybe even commodities like gold. The cool part is, you buy just one share of the ETP and boom, you've got a piece of everything inside. And the best part, it trades on a stock exchange, just like any other company's share.
So what makes ETPs so unique? Well, for starters, they're exchange-traded. That means you can buy or sell them all day long while the market's open. No waiting around. They're also built to follow a specific benchmark, like the S&P 500. It's this combination of being able to trade in an instant while getting exposure to a whole bunch of assets that gives you incredible flexibility and instant diversification.
Okay, so ETP is kind of a family name, a broad category. And within that family, there are three main members you really need to know about: ETFs, ETNs, and ETCs. And trust me, understanding the difference between them is absolutely crucial.
All right, let's start with the big one, the most famous member of the ETP family, the Exchange Traded Fund, or ETF. This is the one most people are thinking of when they talk about ETPs. An ETF literally holds the assets it's tracking. So if you buy an S&P 500 ETF, that fund actually owns shares in the companies that make up the index.
And just how popular are we talking? Well, get this. By the end of 2024, there was nearly $1.9 trillion invested in ETFs around the world. Trillion. That number is just massive, and it really shows you there's been a huge shift in how people are choosing to invest their money.
Okay, now for something completely different. The Exchange Traded Note, or ETN. This is where things get a bit more complex. Unlike an ETF, an ETN doesn't own any of the underlying assets. It's basically an IOU, a type of debt, kind of like a bond, that's issued by a financial institution. They're promising to pay you the return of whatever index it's tracking. But here's the kicker: its security is completely tied to the financial health of the company that issued it.
And that's exactly why you'll often see warnings like this one. Because an ETN is an unsecured debt security, you're taking on something called credit risk. What that means is, if the issuer, that bank, goes bankrupt, you could lose your entire investment. Yep, even if the index it was supposed to be tracking was going through the roof. It's a really key risk you have to know about.
And last but not least, we have the Exchange-Traded Commodity, or ETC. This one's pretty straightforward, just like the name says. It's your direct pipeline to the commodity markets. So, if you want to invest in the price of gold or oil, but you don't want to deal with, storing giant barrels or gold bars in your garage, an ETC is built for exactly that. All right, so now we know the different players in the ETP family. But how do they stack up against the old-school option, the traditional mutual fund? This comparison is really the key to understanding why ETPs have become so popular.
The biggest difference really boils down to how they trade. With an ETP, you can see some news break and react instantly. Buy in the morning, sell in the afternoon. A mutual fund? Totally different. You put in your order and it gets processed at a single price at the end of the day after the market closes. ETPs also generally have lower ongoing fees, what are called expense ratios, and honestly, that has been a huge draw for investors. So, to wrap up the good stuff, ETPs give you this incredible, broad access to all kinds of markets and indexes. They're often a much cheaper way to invest compared to a lot of actively managed funds. And because they're so popular, there's usually a ton of trading volume, which means it's generally super easy to get in and out of your position. That's what we call strong market liquidity. But, it can't all be sunshine and rainbows, right? No investment is without risk. So let's finish up by taking a really balanced look at the potential downsides of ETPs, because you need to know both sides of the coin.
So, what should you be looking out for? Well, first, there's the obvious one, market risk. The value of your ETP can go down just as easily as it can go up. Then you have liquidity risk. For some of the more obscure ETPs, it might be harder to sell when you want to. There's also something called tracking error, where the ETP doesn't perfectly mirror its index.
And of course, we can't forget about that credit risk we talked about, which is a very specific concern for ETNs.
And really, that brings us to the central question you have to ask yourself. ETPs are this incredibly powerful tool that gives you access to markets all over the world. But with that power comes responsibility. So the question I want to leave you with is this. When it comes to your portfolio, how are you going to balance that amazing market access with carefully managing these risks we've just talked about? Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.